I think we would really need bad news for not cutting in June.
What could that bad news look like? I mean, what are the variables?
Well, two very bad readings on inflation, which we don't expect, but just to be complete. And maybe on the geopolitical front, oil prices spiking or whatever can happen. But I mean, the base case, I guess, is that we cut in June. Yeah.
If you cut in June, is there a potential to follow up in July, or is that too swift to follow through with another move when some of the members are talking about gradual reductions?
I would probably be on the cautious side. I would certainly not exclude it, but of course we have this, I mean, inflation has been going down. That's the good news, and it's going down a bit faster than we thought. It also means that our projections, our models are performing better. So they give a sort of trajectory, an anchor to how we get to 2%. And we know it depends on wage developments going down to some extent, on productivity going up, on profit margins going down. So far so good. I mean, we're moving in the right direction, but we will remain data dependent. And I would not put too much the focus on one or two readings of inflation. It's really the full setup with including the projections, what we see on the wage front. And then on the basis of that, we're going just to judge whether we are still moving in the right direction. What makes it a little bit more complicated is that, of course, services inflation is still at 4%. So if you cut rates, you're not restrictive anymore for that part of the economy. But at the same time, we are quite restrictive for other parts of the economy where inflation developments are lower. And so on the basis of that, it makes it a bit more difficult than if oil prices development would be at 2.4 and going down, of course.
Can we talk a little bit more about how restrictive policy is? Because there is a view that the neutral rate is 2 to 2.5%. That was what Villeroy Diccolo told me earlier today, that if that is the rate, then a 4% on the deposit rate, that is restrictive territory, isn't it? So you could afford a couple of rate cuts.
Honestly, I don't like to look at R star, because we're talking R star in nominal terms. You need really to look at the real rate. We believe R star, but the uncertainty is big. It's probably slightly positive in real terms. So 4% is restrictive if you look at average inflation, that's for sure. But again, it's not so restrictive if you look at services, for instance, in Europe. But again, I mean, when I say the base case is probably we're going to cut rates in June, it's because as inflation goes down, real rates go up. And so there is some room for removing some restriction. How much, we will see.
It is a two-speed economy, though, that is unfolding in Europe. Manufacturing, for instance, is in the doldrums. Very weak numbers continuing to cross. Are you concerned that policy is too tight for manufacturing?
I mean, part of the issue with manufacturing is cyclical, but also part of it is structural, has to do with higher, for instance, energy prices. We're also more ambitious on the climate front. So that's part of the story. But indeed, I mean, the European economy has been stagnating for close to a year and a half, and that is an element we need to take into consideration. And if the risk on the inflation front are balanced, and I think they're relatively balanced, the fact that the economy has been quite weak is maybe an additional argument for releasing some of the restriction, yes.
To this point, we've had a report from Mario Draghi this week, we've had one from Enrique Letta, both effectively calling on Europe to step up its competitiveness. As we talk about you setting very key policy for Europe, a lot of the factors beyond your control, because Europe needs to tackle some of the structural issues.
Yes, and I mean, we are still in a world with a low R star, so we are still in Europe in a world where there is maybe more savings than investment opportunities. So, I mean, real rates, forward rates are still low. So the issue is really much more investment opportunities and setting the incentives right also on the climate front, which we do with the ETS and so on. Much more than, because you hear a lot that we need to find so many billions of euros. Well, it's not really about finding that money. I mean, the money is there, it's available. The savings potential in Europe is actually quite high. But you need to create the conditions or improve the conditions for investments to take place.
I want to pick up on the inflation story, because in the past you've said there are asymmetrical risks here around inflation. But the reality is 2% is in sight now. You're very close to that range. Are you still concerned then that we could see a reigniting of inflation even from this level?
It is a risk. It's not the base case. Again, inflation has been moving in the right direction. Our models have performed very badly when inflation was going up. We thought it would come down quickly or not go as high as it. But But over the last quarters, our models have been performing better. So really, I mean, we are comfortable that it's moving in the right direction. You cannot ever exclude, but I think we would need some external shock for inflation to really go in the wrong direction. And then it's more a question of pace. If it keeps moving in the right direction, how fast can you remove a restriction?
Barring any external shock, is it possible to sketch out a rough idea for further rate cuts this year? Could you actually consider 4 as a possibility?
Again, I don't want to exclude anything. The markets have been going all over the place. So when they were expecting 150 basis points of cuts, I clearly said, I find this too optimistic. I think now you've seen a correction. But again, inflation in the service sector in Europe is still 4%. So does it allow for rates to go to 3% quickly? Again, we'll look at the wage developments, we'll look at inflation headline, but also the different components of inflation.
I want to ask you about the Belgian economy. It's one of the fastest in the Eurozone. Some of the reporting suggests that it's because of the types of companies you've got in high margin industries. Flanders has been called out as one particular area where you're seeing that strength. Are there lessons here for Europe as it talks about repositioning for the future?
Well, I think the reason why we performed better and with 1.5% growth last year, which was much better than the neighboring countries, part of it we can explain because we have a high deficit. Public finances are going in the wrong direction in a way, but also we have automatic wage indexation, so the purchasing power of people has been quite well protected, and so private consumption has been quite robust over the last 2 years. Of course, we had losses in competitiveness that, because of these wage developments. What was really the very good surprise, and honestly we don't really explain it very well, is that we had a very strong growth in private investment. 6% in 23, but even 15% over 18 months period, which is extremely robust. We don't have a good explanation for that. If we talk to firms, they are telling us it's about automation, they don't find the workers, and it's also about energy climate. And so it's mostly defensive investments. It's really not expansion, but indeed, it's going certainly in the right direction. In terms of investment.